Yeah, welcome back, traders. In lesson one, we talked about psychology and mindset. Today, we are laying the foundation of your trading journey, understanding what Forex really is and how the market operates. By the end of this lesson, you will not only understand the terms and structure, but you will also be able to open a broker app or chart and actually know what you're looking at. So now in this lesson, we are going to be talking about the meaning of forex, and we're going to be talking about the major currency pairs, the minor currency pairs, and the exotic pairs. Then we are going to be talking about how the forex market actually work. Then we are going to be talking about the basic terminologies of forex trading, which are PEEP, lot, leverage, margin, spread, and so on and so forth. And then we're going to be talking about the market session and their volatility, which we have three basic market session. Some people say it's always four, but nonetheless, three basic market session: the Asian session, the London session, and the New York session. Then we are going to be talking about liquidity and volatility patterns. And then we are going to be talking about the broker types, ECN versus the market makers. Then we are just going to take a self exercise, and then that will be all for this lesson. And I'm going to be making sure that we dive deeper into each of these terms to detail. So yeah, let's move on now. So for this lesson, I'm going to be majorly using the whiteboard so that you can see what I'm trying to, explain. So now, what is Forex? Forex is just basically the foreign exchange. That's the full meaning of Forex. Let me write it down. Forex is basically foreign exchange. That's Forex trading. So foreign exchange market. And what is foreign exchange market? Foreign exchange is the global marketplace where currencies are traded. Just imagine traveling from another country, then you exchange your money for theirs. That's basically forex. That's a forex transaction, but on a massive scale with trillions of dollars moving every day. That is the forex market. Now, let's talk about the currency pairs. And we have three major types of currency pairs. We have the major currency pairs, we have the major currency pairs, we have the minor currency pairs, and we have the exotics. I'm going to be giving examples under each, and also I'm going to be explaining it. Now, what is a major currency pair? A major currency pairs are pairs that always include the US dollars with it. For example, we have Euro USD, Euro USD, which is the euro against the US dollars. Then we have GBP USD, GBP USD, which is the Great British Pound versus the US dollars. And we also have another good example, which is the USD JPY, which is the US dollars versus the Japanese yen. These are the most traded, meaning lower cost and higher liquidity, because what a trader needs in the forex market is liquidity. You need a pair that is very volatile. Another example of a pair that I love trading is also gold, which is XAU USD, the gold versus the US dollar. I like trading this pair a lot. And we also have some other pairs like crypto pairs, for example, BTC USD, which is the Bitcoin against the US dollars. So now moving on, we have the minor and the exotics. Minor pairs, they don't include the USD. For example, Euro, Euro GBP is an example. AUD JPY, which is the Australian dollars against the Japanese yen. You can just go online and just search for major, minor, and exotic pairs and just like see how it is. It's very, very fascinating. But the most popular is Euro USD. The most volatile is XAU USD. That's the most popular pair is Euro USD and the most volatile pair is XAU USD. And a lot of traders love XAU USD because of its volatility and its massive movements. There's a lot of opportunity if you know what you are doing in XAU USD, which is good. Now, the minor pairs, for example, Euro GBP and AUD JPY, and then the exotics. The exotic combine a major with a less common currency. For example, USD, we know that the US dollar is a major currency against the TRY, which is the um Turkish lira. Yes, Turkish lira. I wanted to remember that. So we know that USD is a major currency. Then the Turkish lira is just like a developing market. So that's why it's an exotic. Another example is USD NGN, which is the US dollar versus the Nigerian naira, is also an example. There are a lot of examples. Exotic pairs tend to be riskier because they are less liquid and kind of move choppily, like more volatile. The volatility is kind of crazy. Let me put it that way. Now, an example story. Let's say you are in Europe and you are planning on a trip to Japan. You will need to change your euros to yen, obviously. That exchange rate fluctuates every single day, and traders profit from these fluctuations. That is the main thing of trading. That's how traders make their money. They make their money through market fluctuations between currencies. Now, let's talk about how the forex markets work. Let's talk about how the forex markets work. We have the players in the market. We have the central banks, we have the commercial bank, we have the big institutions and hedge funds. Hedge funds. Let me just write this down. Hedge. So that you know. You can just Google search some of this, and though all this part is just a basic foundation for you to be able to you know what you are really doing in trading. Then we have people like you and I, which we call the retail traders, and we also have the retail brokers. So now the central bank, they are the ones that control the currency value through interest rates. So in later lessons, we are going to be looking at the fundamentals like the FOMC, which is the um, Forex Open Market Committee. I think is it Forex or Federal Open Market Committee of some sort. You can also Google search this and you know what I'm talking about. Then we have the commercial banks. These are the ones that handle most of the transactions. Like I said, the central banks handle the interest rates, and then the commercial banks handle most of the transactions. And the big institutions and hedge funds, they are the ones that trade in big amounts of money. Like they trade billions of dollars in the market. And then we have the retail brokers. That's people that connect us to the markets. So these are the guys that connect people like us to the market. And then, like I said, the retail traders are you and me. Now, let me use this analogy for you to be able to just grab all what I'm saying here. Think of forex like a giant ocean. Central banks are the tides, commercial banks are the big ships, Hedge funds are the speedboats, and we retail traders are surfers riding the waves. Do you get it? So we don't control the ocean, but if we learn how it moves, we can surf profitably. Do you get the analogy now? Let me repeat myself. Forex is like a giant ocean. Central banks are the tides. They control the movements of the markets, like how the tides control the movements of the ocean. Commercial banks are the big ships. Hedge funds are speedboats, and we retail traders, we are surfers riding the waves. If we should ride with the wave, we become profitable. If we ride against the wave, we lose money from the market. Now let's go to the next um topic. So we want to talk about the key terminologies of forex trading. So I've already talked about one, which is the currency pairs, which I talked about the major, the minor, and the exotic. So now we are going to be talking about some major terms that every trader needs to know, and the most important I would say is pips. Pips. Lot size. This is also very important. Then leverage, margin, spread, then the bid ask. So now, what are pips, or what is a pip? A pip is the smallest unit of movement in a currency pair. Now, let me just give the full meaning of pip is percentage in points. There's also another full meaning. I've forgotten, but there are two though. For example, if Euro USD moves from, let's assume, 1.1000, let's add another zero, to 1.10010, that's a pip movement. So if you notice, a pip is the value fourth value. As you can see, if we should subtract this, it's going to give us like 0.000010. So this is a pip, and this one is a pip, and this 10 is a point. So it's going to be 10 points like that automatically, and this is going to be 10 pips. One pip rather. I'm sorry, one pip, 10 points. Do you get it? Now let me go to a live chart so that you see exactly what I'm saying. So as you can see, this is Euro USD, and I'm on the 5 minutes time frame. If we should zoom out a little bit, we can see the current price level. The current price level is 1.16745, and then if it should move to 1.16755, that's a peak movement and also a 10-point movement. Do you get the analogy now? So let me just draw the price range for you. Let's see the measurement of this candle. As you can see, this candle is a 3.1 pip movement. So that's a 31 points. As you can see, 0.00031, which is 3.1 pips, 31 points. Do you get the analogy? Yeah, that's that about that. So apart from Euro USD, we also have for USD JPY, and then XAU USD. So for USD JPY, like I said, to calculate the pip on Euro USD and majorly other pairs that have four four to five, this thing, we know that it's on the fourth decimal that the pip is. But for USD JPY, it starts from the second. So if we have something like 170.6, if price moves to 170.7, this is a peak movement. Let me show you exactly what I'm talking about. Sorry, I said I meant, let's assume 170.65, then 170.66. Now this is a peak movement. I meant on the second decimal place, not the first, the second decimal place. So let's assume it was 650,660. Now that is a this is a 10-point movement and a one peak movement. Do you get the analogy? Now let me show you an example on the charts. Now this is USD JPY, and as you can see, we can see 147.443. Then you can see that it's in three decimals. So let's assume we want to measure for this. Now as you can see, this is the 9.1. It's the candlestick measures 9 pips, 90 points. As you can see, 0.090. What did I say? On the second decimal place. And then we can see it's a 90 points movement and a 9 pip movement. Now, for XAUUSD. For XAUUSD, the it's kind of different, but it's the same. um what should I call it? It's the same. um I don't know which word to use, but for XAUUSD, let's assume we have something like prices at 3,500.000, and then price moves 3,500.100. Now, usually this is a 10 pip movement. Usually this is a 10 pip movement. But if we were to, calculate how much money we would be making, we will start our pip movements from here, not from here. Let me show you what I'm talking about. On the chart, you see that it's going to start from here when we measure it. So this is a typical XAUUSD chart, and let's measure this candlestick right here. As you can see, it's telling us 264.3 pips, but when we want to calculate it, like on a when we want to calculate our risk, we are going to use 264 pips. But when we want to calculate how much money we are going to make, we are going to use 26.43 pips. I'm going to be talking about lot size in the next thing I'm going to be talking about. So you are going to understand why I'm saying this. If you want to calculate your risk, which lot size to use, you have to use 264.3 pips. But if you want to know the amount of money you are going to make on that trade, then we usually count it as 26.43 pips. So we just move, the decimal just up once. That's it. So the next thing now is lot size. Now we have like basically three types of like lot size. We have the standard lot size, we have the standard lot size, then we have the um mini lot size, and then we have the micro lot size. So the standard lot size is 100,000 units of a currency. Mini lot size is 10,000 units of a currency, and micro lot size is 1,000 units of a currency. Now, a micro lot size is usually represented as 0.01, a mini lot size is 0.1, and a standard lot size is 1. So now, like I said, when you want to calculate how much money you will make, when I was talking about pips, now for every pip movement, when you use a micro lot size, it moves, you make 10 cents for every pip movement. For every pip movement, when you use a mini lot size, you make $1, you make $1. And for every pip movement, when you use a standard lot size, you make $10. And if the market is against you by 1 pip, you'll be in a drawdown or you lose $10. Likewise for 0.1 and for 0.01. So, which is why it's not logical when on a $50 account you use a lot size of 1, which is how we are going to be talking about leverage. So, like I said, on a $50 account, it's not logical to be using a lot size of 1, because if the market move against you with 5 pips, you lose the whole money in your account. And even how are you even able to, open a one lot position on a $50 account? Is through leverage. If the leverage is large, then you can trade that amount. So it's logical to use 0.01, because if it moves just 5 pips, that against you, that's 50 cents. And until it moves like 500 pips before you lose the whole money. That's that about that. So that's that about calculating the amount you're making. So like I said, for gold, when you want to calculate the amount you're making, you have to make sure that you change the you have to, because if you want to calculate the lot size you want to use, for example, let's assume we have 3,500.000, and then your take profit is 3,505.000. Now, when you're calculating your risk, you are going to say this is 500 pips. But when you want to calculate how much money you are going to make per pip movement, you are going to say it's 50 pips. Do you get the analogy now? So now, what is leverage? What is leverage? Leverage is like borrowing money from your broker to control bigger positions. For example, if your leverage is 1 is to 1,000, it means you are going to be able to control 1,000 times your balance. Let's assume your balance is $100 and you have a leverage of 1 is to 1,000. Then you are going to be able to control 100,000 units of a currency. So meaning you can be able to open one standard lot size on a $100 account. Can you imagine? But let's assume you have a leverage of 1 is to 100, then you can only control 10,000 units of that currency, meaning you can be able to open a mini lot size position on that account. And let's assume you have a 2,000, 1 is to 2,000 leverage, then you can be able to control 200,000 units. So on a $100 account, you can open a lot size of two whole lot size, and for every pip movement, you make $10. And if price should move against, $20, since it's two lots, if price should move against you with 5 pips, you are done. You are done on that account. So which is why we shouldn't over leverage, like I talked about in the first lesson, um under psychology. We shouldn't over trade, we shouldn't be too greedy and stuff like that. So which is why we want to be using a reasonable leverage. You can use 1:1,000, you can use 1:2,000, but it means you shouldn't be opening two lots on a small account, on like $100 account, because you are using a leverage of 1:2,000, except you are ready to lose the whole money. If you can lose it, then it's fine. It's fine. So, like I said, with a leverage of 1:100, $100 controls $10,000 worth of the currency. And like I said in the psychology lesson. So now, margin. Margin is the amount your broker locks as a security deposit. Without enough margin, you can't open trades. So, for example, now on this $100 account, I opened two lots. Now, the margin could be, let's assume 90%, 10%, and then the leverage is 90%. Like I said, leverage is like borrowing money from your broker for you to be able to, because if your leverage is 1:1, you can't even open any position on the $100 account because it's not even up to, for example, if it's a $1,000 account, yes, you can open a micro lot size of 0.01. But that is the main essence of leverage, for you to be able to open bigger positions, for you to be able to make more money. You understand? So, like I said, margin is the amount your broker locks as a security deposit. So, if you don't have enough margin to open a position, for example, different peers have different, like their own different margins. For example, XAUUSD might be big, Euro USD might be smaller because their volatility is different. So, you get the analogy for margin. So, now margin, let me explain margin and leverage in a real world scenario. Let's assume you want to open a business now. You want to open a business and you have a certain amount of money. Let's assume you need $500,000 to open a business and you already have $50,000 in savings. Then you go to the bank to leverage their money. You go to the bank to leverage their money so that you can be able to open this business. That is how it is in trading. You want to open a trade, then you have a certain amount of money, $100. Then depending on your leverage, it's as if the broker is borrowing you a certain amount of money. That's okay, open this position. But if the trade goes against you, then you are going to be losing this $100 in this scenario, $50,000. But then they will collect their money back, meaning the trade you open is not affecting the leverage, it's not affecting the amount of money they are borrowing you. Do you understand it now? So that's that. So now, spread is the difference between the buy and sell prices, which is the ask and bid price. So spread is how brokers make their money. So they make their money on spreads, on commissions, on swap and like that. But majorly they make their money on spreads. Let me give an analogy. You buy a certain amount of products for $100 and then you sell for $101. Now, in this example, this is the bid price. Just like in mathematics, we have selling price and cost price. That is how spread is. Spread is the profits that a broker makes off of you. So even though you lose the trade or you win the trade, it doesn't matter. They still make that certain amount from you. So the spread could be, it depends on the broker and it depends on the instrument. For example, a popular broker like XNES, on a standard account, the spread is a 1.1 pip movements. So meaning they are making $1.1 off of you depending on the lot size you use. If you use a standard lot size, they are going to be making $11 from you. If you use a mini lot size, they are going to be making $1.1 from you, and if you use, they are going to be making 11 cents from you. You get the analogy. So that is so no matter if you win or you lose the trade, they are still going to make money off of you. And then bid and ask is just basically the um buy bid is the selling price, and then ask is the cost price or the buying price. Do you get? So if you've maybe you've ever been to a currency exchange shop, you see two prices, what they sell to you at and what they will buy from you at. That's the same as forex. So moving on to market sessions, like I said, we have three major types. Then we have this last one. Then we have the Asian session. The Asian session is basically the Tokyo session, and this Tokyo session there's majorly low volatility, and it's mostly range bound. So meaning it's most of the time just consolidates, meaning there's no clear movement of the market. Probably the market is just ranging. That's what Tokyo session does most of the time. Then London session, it has high liquidity and big moves. It has high liquidity and big moves. Then New York session overlaps with the London session, with London, and it is the most volatile. New York session is the most volatile, and this is the session I love trading gold on. This is the session I love trading gold on. So basically, the overlap between London and New York is when the market moves crazily, probably because of news or because of the markets open and stuff like that. So the interlap between London and New York session, that's when the market moves very well. And then we have the Sydney session, which starts the week basically. So if you want to know the time um in which these sessions are, you can just go to Google and search for market session, forex market session, and you see the time there. You see the time there. So you might see in GMT, which is the London time, or UTC, which is also the London time. Then if you see EST, that's the American time. So there's not much to really talk about here, but you don't really want to be trading during this time and this time, except if you are in those time zones. But basically, the major time you want to be trading is the London and the New York session. So now we have liquidity and volatility. This is just a short topic. So liquidity is how easily a currency can be bought or sold. For example, the major pairs are the most liquid pairs. And then volatility is how much price moves. Good traders love volatility, but you need discipline to handle it. For example, like I said, gold is the most volatile pair I know. Then probably the next is GPP JPY. GPP JPY is also very volatile because of the British and the Japanese yen. So yeah, that's that about that. Then an important thing to talk about is the brokers. The brokers type. We have the market makers and then we have the ECM brokers. The market makers, they are the one that act as like a counterparty to your trade. Sometimes create artificial spreads So you have to beware of those brokers. They basically just want to take your money, and it's not a scam. It's not a this thing. That's how the market is. So that's why you have to also be beware of brokers you put your money on or you trade with. Then the ECM brokers, these are the good ones. They connect you directly to the interbank market. They connect you directly to the big guys of the market. So usually tighter spreads, but commissions obviously. So for example, any broker that offers like no commission, just know that they are market makers. But if there's commission, then obviously they are connecting you to a bigger, you know, you get what I'm trying to say. Then an advice that I would just tell you is that always research your broker, look for regulation, transparency, and ease of withdrawal. A good broker is like a good doctor. You must trust them with your financial health. So yeah. So that's all for this lesson. So let's just quickly recap what we learned, what Forex is, how it works, key terms, session, liquidity, and brokers. So if you don't understand anything, you can just like go back or you can ask me question. So what I want you to do now is to download MT5 from the Apple Store or Play Store, MetaTrader 5, MetaTrader 5. And then you can download TradingView, TradingView and then research any broker and then I won't really but the broker I love using is Just Market. Just Market is the broker I love using. It's as ease of use and also Xness sometimes. Xness. Yeah, these are the two brokers I love using. They are also market makers if you are using the standard and pro accounts, but if you are using the raw spread and the zero spread, they are basically. But if you have a small account, you can just basically go for the standard accounts. For Just Market, you can go for the pro, meaning the spreads are very tight. You can have spread as low as 0.1 pip on gold. It's very surprising. It's very surprising. So yeah, Just Market. And for their pro, it's the um lowest is $200, but Xness is $3,000. So you have to have like $3,000 before you can use the pro. But the standard, the spread too is okay, like 1.1. So yeah, so that's that about this lesson. So you can just on your trading view, you can just observe Euro USD, GBP USD, USD JPY, XA USD. Observe those different pairs, play with them. Just make sure to just interact with them so that at least you'll be like you know what you are doing. So that's all for this lesson. See you in the next lesson. Thank you.